Last week, I sat in on a pitch that felt like it came straight out of a manual for the future of business. A founder, barely out of their 20s, was showcasing their new line of personalized supplements. They hadn't hired a single designer, copywriter, or marketing strategist. Everything, from the product branding and the website copy to the social media campaigns targeting micro-influencers in Nigeria and Indonesia, was generated by AI. The numbers were impressive. They went from concept to global sales in under 3 months, with a fraction of the traditional startup costs. You could feel the energy in the room. A few of the older investors were looking at each other, a mix of awe and maybe a little fear. This felt like the disruption everyone had been talking about, a business model that was infinitely scalable, agile, and almost terrifyingly efficient. But then one of the partners asked a simple question. What happens if the platform you're built on changes its algorithm? The founder just smiled and said, "We'll adapt. The AI will figure it out." There was no plan B, no consideration for data privacy regulations on the horizon, or what would happen if their supply chain, entirely dependent on a single drop-shipping giant, suddenly faced a new tariff. And in that moment, the entire brilliant venture suddenly looked incredibly fragile. It was a perfect illusion of a modern business built on a foundation of shifting sand. This is the new paradox for anyone in business today. The most incredible opportunities are now inseparable from the most invisible, catastrophic risks. And learning to see the difference is the only thing that will separate the real winners from the spectacular failures. You just heard me recount an experience that really stuck with me. It perfectly illustrates the central question we're diving into today. How do we navigate a world where the most incredible innovations come hand in hand with unprecedented, often unseen risks? We're going to unpack the cutting edge of business strategy, consumer behavior, and ethical considerations, exploring how hyper-personalization is reshaping markets, what it takes to succeed in dynamic global economies, and the critical ethical questions in rapidly advancing fields like longevity science. This isn't just about understanding what's next. It's about seeing the true landscape, both the dazzling peaks and the hidden crevasses.
It's fascinating, isn't it? Because the pace of change now, it really does outstrip our traditional frameworks for understanding and managing risk. We're witnessing this powerful convergence of artificial intelligence, these profound demographic shifts, and, rapidly evolving consumer values.
Yeah.
And this potent cocktail is creating these immense opportunities that promise to revolutionize industries. But at the same time, it also introduces significant, often invisible vulnerabilities.
Exactly, like that startup.
Precisely. So the key for businesses, and for individuals too, really isn't just to identify the next big trend, but to understand the underlying fragility of ventures that might seem invincible on the surface. Much like the startup you described. It's about developing that foresight to see not just the immediate win, but the long-term resilience or the potential for spectacular failure, the AI-driven hyper-personalization revolution and its intricacies.
Okay, let's unpack this core idea then. The thing that drove that startup's initial success, and like you said, its potential fragility. Artificial intelligence and its, astonishing ability to hyper-personalize experiences. It's genuinely changing how companies engage with us, the consumers, right? At a fundamental level. It feels like the market's finally caught up to that old promise of knowing your customer.
Indeed, the shift has been, profound. We've moved through these really distinct phases from, rudimentary mass marketing, treating everyone the same, to segmentation, which started dividing people into broader groups.
Right, like demographics.
Exactly. Then came personalization, a bit more tailored, maybe based on past purchases or basic info. But now we're firmly in the era of hyper-personalization, and that's an entirely different beast. This evolution isn't just because the tech got better, it's a direct response to our increasing demand as consumers for experiences that feel genuinely relevant, unique, and almost predictive of our needs.
We expect it now, don't we?
We do. And the research backs this up overwhelmingly. A huge 77% of consumers have actually chosen, recommended, or even paid more for a brand that provides a personalized service.
Paid more, just for being understood.
Precisely. Think about that we're willing to open our wallets simply because a brand gets us. And conversely, a big majority, 71%, feel actively frustrated when their shopping experience isn't personalized. It's not just a preference anymore, it's really a baseline expectation. Generic, one-size-fits-all stuff. It just doesn't cut it in today's market.
Too much noise.
Exactly. Our attention spans are shorter, choices are endless, only those messages that truly resonate cut through. And this profound shift, it's reshaping how businesses approach, everything. From product development right through to customer retention, it's about connection on a much deeper level. And the power behind this transformation, it lies in this sophisticated suite of advanced technologies working together. We're talking AI, obviously, but also its specialized branches, machine learning, which lets systems learn from data.
Without being explicitly programmed.
Right. And natural language processing, NLP, letting computers understand and generate human language.
Yeah.
Then there's predictive analytics, forecasting future behavior and behavioral modeling, figuring out human actions and preferences.
So it's not just one thing, it's a whole toolkit.
It's a unified ecosystem. They work together, analyzing truly vast amounts of customer data purchase history, browsing behavior across devices, social media engagement, click streams, demographics, psychographics.
Yeah.
Everything.
Wow.
And from these raw data points, they pull out deep insights, predict individual preferences with, frankly, uncanny accuracy, understand complex customer questions, identify high potential leads with remarkable precision, and this is crucial, adjust strategies in real time. Imagine a system constantly learning and adapting its approach to you as you interact.
It sounds almost alive.
In a way. And the numbers really underscore this staggering impact.
Yeah.
A striking 75% of customers are more likely to buy from a company offering personalized experiences. That speaks volumes about loyalty and conversion power.
Feeling understood drives sales.
It really does. Furthermore, 80% of companies that have already implemented hyper-personalization report a tangible increase in sales. And a dedicated study, it found a remarkable 10–15% revenue increase just from adopting AI-powered personalization. It's a direct link to the bottom line. This isn't just fluff about making customers feel special. It's about generating measurable, sustainable business growth by building genuinely meaningful connections.
That really brings the theory to life, doesn't it? It's not just a concept anymore. We've got concrete, real-world examples of businesses using these AI strategies right now, and it's fundamentally changing how they operate and succeed.
Absolutely. Let's take a major online retail giant, for instance. You know the type, the one that consistently pops up product suggestions so accurate you often find things you didn't even know you wanted, but suddenly realize you absolutely need.
Huh. Yes, I know the feeling.
Dangerous for the wallet. Tell me about it. But they didn't achieve this by accident. They integrated this huge array of customer data points. Your purchase history, your detailed browsing behavior across their website, their app, even your interactions on social media. This complete data picture allowed them to build a remarkably full profile of each customer.
Going beyond just what I bought last time.
Way beyond. And they didn't stop there. They went a step further, using advanced generative AI, Gen AI, to brainstorm diverse content ideas and tools like copy.ai, which is specifically designed for generating marketing copy automatically, to analyze buyer behavior and broader industry trends. This let them generate data-driven insights at scale, feeding their sales and marketing teams with granular, actionable intelligence. It's about anticipating what you might want next month and crafting a message that really hits home.
Okay, that sounds incredibly powerful for driving sales, but for you, the listener, it immediately brings up those privacy questions. How did they handle that? It's a huge concern for all of us, giving away so much data.
You're absolutely right. Privacy and data security were monumental challenges for them. Operating globally, they had to strictly comply with complex rules like GDPR in Europe and FTC guidelines here in the US. Their solution was robust, involving multi-layered data encryption everywhere, protecting sensitive info whether it's moving or just sitting there.
So lockdown tight.
Very. They also enforced strict access controls. Only authorized people with a real business need could see specific data. And rigorous security audits and penetration testing were just standard practice, allowing them to find and fix vulnerabilities proactively.
Before something bad happens.
Exactly. And crucially, they adopted transparent data governance policies, not just buried in fine print, but clearly communicating how data would be collected, stored, and used. And perhaps most importantly for trust, they offered clear, easy ways to understand data usage and straightforward opt-out options for anyone not comfortable with the personalized recommendations. It's not just legal box ticking, it's strategic for keeping customer trust. And beyond privacy, they also faced that significant technical hurdle, integrating this sophisticated new AI system with their extensive existing infrastructure. Think legacy systems, big platforms like Salesforce for CRM, HubSpot for marketing.
Yeah, that sounds like a nightmare, plugging new tech into old pipes.
It required meticulous planning. They developed this comprehensive system architecture, mapping out exactly how the new AI would talk to all the existing, often disparate systems. They used advanced integration tools like MuleSoft, known for connecting complex systems seamlessly. This ensured smooth data exchange, creating that single unified view of the customer And the whole process was backed by rigorous testing at every step, making sure the AI worked as intended without disrupting anything.
Okay, so after all that complex integration, navigating the privacy minefield, what were the actual results for their bottom line and for the customer? Did it pay off?
Oh, it absolutely paid off. The results were truly impressive. This retail giant saw a substantial 20% increase in conversion rates.
20% jump in people buying.
Huge. And their average order value also went up by 15%, so people were buying more or more expensive things. Plus, customer satisfaction scores climbed by 12%.
So happier customers spending more money.
Precisely. And the customer testimonials really highlighted the accuracy and relevance. People were genuinely surprised, saying things like they ended up buying several items I hadn't considered, or it made shopping so much easier and more enjoyable, like having a personal shopper.
That's powerful feedback.
It is, and it aligns with broader industry data. Companies using AI recommendations well can see up to a 25% sales increase. And critically, 77% of customers say they're more loyal to brands that personalize. It's a clear win-win, more revenue and deeper lasting customer relationships.
That's a great B2C story, but it's not just about selling directly to consumers, is it? How does AI work in the, well, often more complex world of business to business? That feels like a different game altogether. Longer sales cycles, deeper relationships needed?
You're right, the B2B landscape has its own unique dynamics, but AI is proving just as transformative there. We saw a B2B technology firm use AI to build this incredibly effective predictive lead scoring system, instead of sales teams manually sifting through every single lead.
Which must take forever.
It's exactly. This system automates it, intelligently identifying and prioritizing the prospects most likely to convert. They integrated a remarkably diverse set of data sources to do this: core CRM data interactions, sales history, alongside detailed website interactions like page views, time on site, bounce rates.
Okay, standard enough.
But they also pulled in technographic data, what tech stack a company uses, its size, industry, even recent funding rounds. And they didn't ignore social media engagement, which can offer clues about interests and pain points. Combining all this created a really comprehensive lead profile. Then the firm developed this sophisticated AI model using machine learning and NLP. The algorithms detect subtle patterns in the data, identifying traits of leads that historically turned into customers. But it wasn't static. Continuously. It was refined iteratively. They'd feed in new interaction data, test the model's accuracy against actual sales, tweak the algorithms, and deploy the updated model. This constant feedback loop, new data improving the model's predictions, was crucial for its long-term accuracy. It's like having a data scientist constantly optimizing your sales approach.
Those advancements are pretty remarkable. What was the actual measurable impact on their sales team? Did it make them more efficient? Did it change how they worked?
The impact on efficiency was, well, dramatic. A real game changer. Before the AI system, their sales team spent an average of 25 hours per week just on lead qualification, just figuring out who was worth talking to. And their conversion rate from that effort, a modest 15%.
Wow, 25 hours just qualifying leads.
Think about that time. After integrating the system, qualification time dropped to just 10 hours per week. That's a 60% reduction. But here's the kicker. Their conversion rate for those AI prioritized leads jumped to 25%.
So less time spent, much better results.
A 67% increase in conversion. It meant their sales reps weren't chasing dead ends anymore. They focused their energy and expertise on the most promising opportunities. That led to more effective conversations and, ultimately, more closed deals. It really shows how AI can empower human teams to be far more strategic, and that efficiency gain, naturally, translated directly to revenue growth. The firm reported a 22% increase in quarterly sales, a significant jump. Alongside that, they saw an 18% increase in the average deal size.
So more deals and bigger deals.
Exactly. They were closing more and securing larger contracts. These figures actually beat the McKinsey research estimates, which usually suggest maybe a 10–15% productivity increase. It really shows how well this specific system worked. Focusing on the right leads and enabling teams to personalize their engagement clearly led to better conversations and higher win rates. It's not just automation, it's empowering humans to be more effective and, well, more profitable.
Okay, moving to another sector. A financial services firm. That sounds like a particularly complex environment for this kind of personalization. You've got sensitive information, high stakes, trust is absolutely paramount. Yeah. How do they approach it? What safeguards did they need?
It is indeed a highly regulated and sensitive area, which makes their success really noteworthy. This firm built a truly robust, real-time personalization framework. At its heart was an advanced, event-driven architecture. What that means, basically, is they capture and process every single customer interaction, clicks on the website, app inquiries, platform decisions in real time as it happens.
Instantly.
Instantly. This continuous stream of data feeds directly into an AI and machine learning decision engine. This engine doesn't just store data, it analyzes it on the fly. It determines the most relevant content, the best financial offer, or the right guidance for that specific customer at that exact moment.
Wow, truly real time.
Exactly. This personalized content is then pushed out seamlessly across different channels: email, social media, mobile apps, using marketing automation tools like Salesforce Marketing Cloud to orchestrate the journey. It ensures a consistent, relevant, hyper-personalized experience, letting the firm anticipate and respond to changing needs instantly.
That sounds incredibly efficient, almost completely automated though. But in finance, where trust and empathy are so crucial, what about the human touch? How do you make sure a customer feels seen by a person, not just an algorithm?
That's a critical point, and they addressed it with a lot of foresight. They implemented what they call a hybrid approach. Automation handles the routine, repetitive, data-heavy tasks, processing huge amounts of financial data, sending standard communications, handling basic info requests. This frees up their human financial professionals.
To do the human stuff.
Precisely. To focus on the higher value, more nuanced activities: strategic decision-making, crafting creative content, and crucially, engaging in those complex customer interactions that absolutely demand empathy, understanding, and that irreplaceable human touch. Managing sensitive financial planning, giving complex investment advice, handling situations needing a deep personal connection.
So AI handles the grunt work, humans handle the relationships.
It's augmenting human capabilities, not replacing them. And Forrester research backs this up. 80% of firms balancing automation and human oversight reported better customer satisfaction, and 70% saw increased revenue. It's a model for delivering both efficiency and real customer relationships.
So with this mix of smart AI and strategic human input, what was the bottom line? What did it do for customer relationships and the firm's finances? How did it redefine value?
The impact was incredibly significant. They saw a remarkable 25% increase in customer lifetime value, reaching an average of $1,200 per customer. That tells you relationships got deeper, more loyal, customers felt understood long term.
That's a big jump in loyalty.
Huge. And critically, their churn rate customers leaving dropped by an impressive 30% within just 6 months. Massive win in a competitive industry. They also saw a 20% increase in cross-selling success. Customers were more open to additional services because the experience felt tailored and trustworthy.
So the trust paid off.
Big time. The initial investment for the transformation AI tools training was around $350,000, but it yielded a 300% ROI in the first year alone. Within 2 years, they reported a 50% increase in overall revenue. It clearly shows that strategic investment in hyper-personalization, especially in a sensitive sector like finance, leads to substantial long-term financial benefits and much stronger customer bonds.
Clearly, AI is this powerful engine driving consumption, dramatically reshaping how businesses engage, but it's also pushing us as consumers to rethink what we truly value, which leads us nicely into the evolving demands of the post-crisis consumer, especially when we look at dynamic, fast-growing markets like Asia. Navigating the new global markets, focus on Asia.
Yes, the post-crisis consumer is definitely demanding a new and often complex balance. They still prioritize efficiency, fair price, transparency. Those are table stakes now. But increasingly, they're also seeking a deeper connection, a sense of identity, and a clear purpose from the brands they choose. This is driving a really interesting phenomenon we call accessible status.
Accessible status. Tell me more about that.
It's this desire for premium experiences, that feeling of aspiration or luxury, but delivered in more democratic, less flashy formats. It's not just about cheaper alternatives. It's a shift in consumer psychology. Brands now need to deliver perceived value that resonates beyond just the price tag. They have to rethink everything from sourcing and quality to brand storytelling.
So how do you maintain that premium feel when the market's wider?
That's the tension. It forces new design thinking, broader appeal, without diluting the brand. It's a huge opportunity for brands that can nail this balance. And when we look specifically at the Asian consumer, these evolving demands are even more pronounced. It signals a real recalibration in markets, often linked with status and luxury. First, there's this undeniable emphasis on substance over form.
Quality over just the logo.
Exactly. Consumers across Asia are becoming incredibly discerning. They prioritize intrinsic quality, craftsmanship, longevity, far more than just a brand name or a flashy image. In mainland China, get this, 92% of consumers define luxury by product quality. not the brand itself. 86% in Southeast Asia feel the same.
Wow, that's a fundamental shift for luxury brands.
It is. The label isn't enough. The product has to demonstrate its value, its durability. It challenges brands to move beyond superficial marketing and invest in verifiable quality.
Makes sense. What else?
Second, there's a clear willingness to pay for proven quality. Most consumers aren't put off by rising prices if they believe the products deliver on craftsmanship and lasting value. We see this across the board. 88% in mainland China, 81% in Hong Kong, 80% in Southeast Asia agree they'll pay more for quality. It's a rational value exchange. Superior quality justifies a higher price, but that price must be earned. Third, luxury is increasingly seen as an investment, not just indulgence. There's a strong trend towards fewer, better pieces. People would rather invest in one high-quality item they can use repeatedly. That's 83% in South Korea, 82% in mainland China, 81% in Southeast Asia.
Thinking long-term.
Exactly. They prioritize desirability and potential resale value too. 88% in mainland China, 85% in Southeast Asia consider this. They're thinking about asset value, not just initial appeal. Brands need to shift their story from just brand image to a product craftsmanship, materials, longevity.
Interesting. And the last point.
Finally, the rise of accessible luxury and dupe culture. Interest in brands offering a high-end feel at more affordable prices is overwhelming. 95% in mainland China, 91% in Southeast Asia agree. People want the experience of luxury, the aesthetic, the quality feel without the huge price tag. And openness to dupes, lower-priced lookalikes is strong too, especially in South Korea, 75%, Southeast Asia, 64%, mainland China, 64%.
So a challenge for traditional luxury, an opportunity for others.
Definitely. Though Japan shows some cultural resistance, interestingly. But overall, it shows a savvy, value-driven Asian consumer demanding tangible quality and a value proposition that matches their priorities.
Okay, connecting this to the bigger picture, it sounds like brands need incredible agility, not just in marketing, but in their core business models, especially in fast-growing, diverse regions like ASEAN. The old strategies just won't work.
Absolutely. The Asian market, Indonesia, Thailand, Vietnam, etc., with 670 million people is a prime example of this new geography of consumption. It's projected to be the world's fourth largest economy by 2030.
Fourth largest.
Driven by 140 million new consumers and nearly 575 million internet users in the next decade. While markets like mainland China still lead in consumer optimism at 94%, the sheer scale and incredible diversity of ASEAN make it a crucial focus for future growth. The challenge and the opportunity is navigating its complexity. And to succeed there, you really need to understand the diverse consumer profiles. ASEAN is incredibly varied, but we can broadly categorize the consumer classes. First, Gen Z, the digital natives.
Born with a smartphone in hand.
Pretty much. They value personalization, sustainability, authenticity. They're the fastest growing segments. You need digital channels, mobile experiences, and genuine social responsibility to reach them. They're millennials reaching their 30s and 40s. They value authenticity, convenience, experiences, social responsibility. Still a huge consumer class with growing spending power.
Experiences over things sometimes.
Often, yes, and convenience is key. Next, the aspirers. This is a fast-growing group moving into the middle class. They seek brand prestige, quality, convenience as markers of their new status. Think graduating from street food to maybe fast food once a month. It's a sign of progress for them. Brands need to offer aspirational products emphasizing value and quality.
And finally, the core middle class.
The burgeoning middle class. Key drivers of growth. They're discerning, prefer quality, value, and increasingly health, wellness, and convenience. Eco-friendliness and family focus resonate strongly too. What unites the younger groups especially is being tech-savvy, well-informed, with a median age across ASEAN of just 31. The pandemic made them more cautious financially, but massively boosted their digital engagement. So you have this dynamic, digital, value-conscious consumer base. Given this landscape, businesses in ASEAN need specific adaptive strategies. First and foremost, one, think local, be local. This is non-negotiable. Gotta go deep. You have to. Adapt products, marketing, production, supply chains to local cultures, preferences, regulations. Be a local brand, not just in the local market. Decathlon, the sports retailer, does this well, focusing on being local in each market, not just French. Local brands often outperform multinationals in some areas, like F&B in Indonesia, because they have those deep insights and agility.
So partnerships are key for foreign brands.
Absolutely critical.
Gotcha.
Leverage global expertise, tech, R&D, but partner locally for market insights, navigating rules, distribution. Coca-Cola with ThaiBev in Thailand is a great example. Even luxury brands benefit from localizing campaigns, using local faces, incorporating local designs, like Louis Vuitton tailoring campaigns for Bangkok. Connect global aspiration with local identity.
Makes sense. What's next?
From bricks to clicks, embracing omnichannel, Southeast Asia's digital economy is booming. $200 billion by 2022, 460 million internet users, 88% smartphone penetration.
Everyone's online.
Everyone. And consumer behavior is fluid. Brand loyalty is fragile. 53% switched their most purchased brand in the last 3 months. The lines between online and offline are blurring. People research online, buy offline, or vice versa. Omnichannel is the norm now in mainland China and Southeast Asia. 60-71% prefer a hybrid approach, moving seamlessly between digital and physical. So, to excel here, businesses need to think beyond just e-commerce. They need shoppertainment.
Shoppertainment, like shopping plus entertainment.
Exactly. Combining shopping with engaging, interactive, often social digital experiences. Shoppable live streams are huge byproducts while watching a live demo or influencer review. Gamification too. Lazada and Shopee use in-app games to win discounts, making shopping fun.
Keeping people engaged.
And crucially, hyper-localization in digital marketing is paramount. Go beyond just translation. Use local influencers who resonate, speak local dialects, use familiar backgrounds and cultural nuances to build real trust. Grab's success in Southeast Asia is a perfect example, deeply localizing services and campaigns everywhere they operate, adapting constantly. And third strategy. 3. Investing in sustainability today. It's not optional anymore. It's a growing priority, especially for younger generations and the private sector in ASEAN. Consumers are showing willingness to pay more for organic, maybe up to 30%.
It's becoming mainstream.
It is. Companies like Sodexo are integrating sustainability across their operations, responsible procurement, reducing air freight using green electricity. Bolloré is segregating waste, investing in sustainable logistics. The challenge is balancing this demand with the actual cost premiums. Developing cost-efficient, eco-friendly supply chains is key to making sustainability accessible, addressing price sensitivity while meeting ethical expectations. It's about making green economically viable.
That's a really clear picture of ASEAN. But it's also interesting how global travel patterns are changing, especially for Chinese consumers. How are those shifts impacting retail worldwide?
We're definitely seeing a notable shift there, particularly with mainland Chinese consumers. There's a marked decline in international travel intent, dropping from 78% planning trips in 2024 down to 58% for 2025.
That's a big drop. Why?
It's likely a mix of factors. Maybe some economic caution, perhaps lingering travel complexities, but it also really points to a renewed focus on domestic consumption and experiences within China. They're still keen on domestic travel, 81% intent there. But this shift has big implications for international luxury brands that have relied heavily on outbound Chinese tourists. And this shift creates different spending patterns. Domestically, Chinese consumers are spending heavily on luxury goods, bringing that consumption home. High intent for beauty and skincare, 58%. Luxury fashion, 54%, jewelry and watches, 50%. It's a robust domestic luxury market.
So they're still buying luxury, just closer to home.
Exactly. But when they, or indeed consumers across Asia, do travel internationally, luxury fashion is still a top category for splurges everywhere. 63% in Southeast Asia, 58% in mainland China, 57% in Hong Kong prioritize it abroad. Beauty, skincare, jewelry are also strong, especially for mainland Chinese and Southeast Asian travelers abroad. Maybe it's tax-free shopping, exclusive products, or just the experience. Brands need strategies for both strong domestic markets and key international hubs and popular destinations. Proximity and cultural affinity are huge drivers. Tokyo, Singapore, Seoul remain strong across the board. New York is rising in appeal globally.
But what about Chinese travelers specifically?
A significant trend is their increasing preference for regional Asian destinations. Tokyo, Singapore, Hong Kong feature prominently in their top 5 international choices. It suggests a shift towards regional exploration, maybe shorter travel times, familiar cultures post-pandemic. Paris is notable as the only Western city consistently in their top 5. Likely, it's enduring iconic status for luxury and culture. But the overall pattern suggests more regionally focused travel and shopping for many Asian consumers, pushing brands to rethink their global retail footprint. Longevity, health, and ethical innovation.
Okay, we've covered AI reshaping consumption, diversifying global markets. Now let's pivot to where AI might reshape something even more fundamental: human life itself. This burgeoning global longevity and integrated health and wellness market feels like the final frontier almost.
It really does. The promise of AI in longevity research is immense. It's becoming this powerful ally in extending not just lifespan, but crucially, health span, the years we live in good health. This market is exploding, driven by aging populations in developed countries wanting to stay vital, and a global quest for better quality of life. It's a whole ecosystem, from supplements and wellness programs to sophisticated genetic therapies and diagnostics predicting disease years out.
Incredible potential.
Incredible. But this convergence of AI, deep science, and the essence of life presents not only huge opportunities, but also significant ethical questions and challenges. They demand our immediate attention. We're pushing boundaries like never before, and the implications are huge. And the ethical challenges are core to doing this responsibly. We're talking about protecting highly sensitive health data, genomic data, medical records. Mishandling could lead to discrimination.
Yeah, that's scary.
Ensuring truly informed consent for long-term studies spanning decades. How do you even do that properly? And critically, the potential for bias in AI algorithms. If unchecked, they could worsen health disparities between groups, widening the health gap, not closing it.
So the tech could actually make inequality worse.
Potentially, yes.
Yeah.
Consider a company like BioMerit, a French biotech firm focused on diagnostics, like tests for infectious diseases or antibiotic resistance. They're integrating these with digital health platforms to track outcomes, identify resistance profiles. Vital work. But even that B2B context, they face challenges defining the Asian consumer in healthcare, adapting diagnostics to diverse market needs, infrastructure levels, local diseases, cultural beliefs, regulations. They need AI insights relevant for local clinicians without bias from Western data.
It's complex even for diagnostics.
Exactly. And the crucial point is, if we don't tackle these ethical challenges head-on, with clear guidelines, proactive measures, the immense benefits of AI longevity, potentially adding decades of healthy life, could be overshadowed by negative consequences. Plus, there's the risk of products lacking real scientific validation flooding the market, driven by hype. That could lead to public distrust, not just of specific products, but the whole field, maybe triggering restrictive regulations that stifle good progress. It's a very delicate balance.
So, given these huge opportunities and very real ethical tightropes, what does building a responsible future look like here? How do we ensure innovation is sustainable and genuinely serves people?
We absolutely need a multifaceted approach to ethical governance. It's not one magic bullet, but a layered adaptive framework. Firstly, adaptive ethical frameworks. AI moves so fast, traditional ethics struggle to keep up. We need ethics by design, embedding ethics into every stage of R&D, not just as a checklist. It's about balancing innovation with caution.
Building ethics in from the start.
Exactly. Secondly, transparency and accountability. Techniques like explainable AI, XAI, are vital. We need to understand why an AI makes a recommendation, especially in healthcare where it impacts lives. It builds trust and allows human oversight.
Stopping the black box.
Precisely. Thirdly, privacy-preserving AI techniques. Things like federated learning training models on decentralized data without sharing raw info and differential privacy, adding noise to protect individuals. They can be computationally challenging, but they're essential, so the quest for longer life doesn't destroy privacy.
Protecting the data is paramount.
Absolutely. Fourth, promoting equitable access. As these interventions get more sophisticated, we must ensure fair distribution. Things like tiered pricing, public-private partnerships are needed to prevent these technologies from just benefiting the rich and worsening health disparities. The goal should be longer, healthier lives for everyone.
Not just the wealthy few.
Right. Fifth, building public trust. This is paramount. It requires transparent, honest communication about goals, methods, outcomes, both possibilities and limitations. Inclusivity is key too, involving ethicists, patient advocates, the public and governance discussions, ensuring diverse values are considered.
Getting everyone involved.
Yes. And finally, international harmonization. Longevity research is global. We need global ethical standards and harmonized governance to avoid fragmented rules, ethical loopholes, or a race to the bottom on oversight. Collaboration is essential. Synthesizing the paradox, the big picture.
So we've journeyed through AI hyper-personalization, the dynamics of global markets like ASEAN, the profound ethical questions in longevity research. It really brings us back to that initial image, doesn't it? Businesses built on shifting sand. That paradox. Incredible opportunity, masking potentially catastrophic risk.
It's truly fascinating because the future of consumption, AI's role, longevity science, none of it is predetermined. These are futures we have to actively shape through deliberate choices, smart policies, responsible innovation. The key for leaders today is cultivating strategic discipline, critical analysis, moving beyond just chasing the latest trend.
Seeing the whole picture.
Exactly. The paradox holds true. Growth often comes from instability. Innovation needs regulation. Concentrated power often hides fragility. Understanding this interplay, this constant dance between opportunity and risk, is what will separate the long-term winners from the spectacular failures. It's about building resilience into everything we do and ensuring innovation serves humanity responsibly, sustainably, upholding dignity as we push the boundaries of what's possible. Outro.
Wow, what a deep dive this has been. We've seen how AI is truly revolutionizing how brands connect with you, the consumer, offering these hyper-personalized experiences, but also how vital it is to manage those underlying risks, data privacy, algorithm dependency. We've explored the vibrant, diverse markets of Asia, especially ASEAN, and how crucial it is for businesses to be deeply localized, truly omni-channel, and committed to sustainability to really thrive there. And finally, we touched on that immense, almost sci-fi promise of AI in extending human life, always remembering that critical balance needed between fast tech advancement and solid, thoughtful, ethical frameworks.
This deep dive really underscores that today's business world is all about constant change and deep interconnectedness. The decisions made about using AI in sales, entering dynamic regions like Southeast Asia, or governing life-altering technologies ethically, they all have profound implications, not just for businesses, but for all of society. Our collective task, really, is to approach these huge opportunities with both courage and wisdom. We need to ensure our pursuit of innovation leads to a future where the benefits are shared broadly, human dignity is upheld, and the quality of life for everyone is genuinely enhanced, rather than accidentally creating new vulnerabilities or making existing inequalities even worse.